Good morning. It's Jeffrey Christian. It's not quite 10 o'clock on Tuesday, the 12th of October here in New York. I wanted to continue the conversation that I started last Friday on the things that matter to gold and to silver. I've gotten the message from various viewers and readers and clients and colleagues within CPM Group. Let's focus on what really matters and ignore all of the noise that we traditionally tried to ignore as much as possible and are famous for saying. So let's talk about that. Now, there's a lot happening in the precious metals markets, and a lot of people are saying, hey, Jeff, could you explain, you said something last Friday that central banks are buying less gold in the last few months than they were in the first half of the year. Why is that? And it's a complex topic. And other people have asked about inflation. Somebody suggested we read The Creature of Jekyll Island, the first passage of which says there was no inflation under gold standards. So that's nonsense. We had another guy who come along and said, hey, inflation is going to be 20% per annum soon, which is interesting because it hasn't been since at least before the Great Depression. So there are a lot of topics that people want to talk about. And today I want to talk about the things that matter specifically and give you a little bit more insights into the way CPM Group addresses the issue of where do we see the gold price going. Friday, I hope to talk about inflation and gold, the relationship, and those things that I just mentioned, both inflation under gold standards and inflation now and going forward, and what reasonable expectations are, and what fear-mongering expectations that are unreasonable are. So I hope to get to that too on Friday. And then next Tuesday, I'll double back and we'll talk a little bit about central bank gold trading patterns. So that's the idea of how to address all of these issues. Subject to change. Yeah, obviously, if the price of gold and silver changes dramatically or the economic environment changes dramatically between now and next Tuesday, we're going to change the game plan. When I was a kid in the 60s in football, we had this concept called broken field runner. And I was a very good broken field runner because when the field broke down, when the play broke down, you could give me the ball and I could zig and zag through a bunch of bodies splayed out over the playing field. And we are nothing if we're not broken field runners. We look at the market, the playing field, and we're constantly evaluating where we are. So things change, we'll change our mind, as John Maynard Keynes famously said. One of the comments that's easily discarded or dealt with right now is people have said, what's the China Evergrande Group crisis? What's its implication for the markets, for the US economy, for the global economy, and for gold and silver? And that's easy, virtually nothing. Evergrande is the tip of an iceberg. There are a lot of problems, structural problems in the Chinese economy. They basically reflect the fact that you've had extremely strong and semi-bridled growth in various sectors over the last 30 years. That's changing somewhat. Xi Jinping is trying to reel in some of the more excessive elements within the Chinese economy. Then he's doing a job on it. I won't go any further. China Evergrande in itself is emblematic of a problem that has been existent in the Chinese economy for some time. The Chinese government has been working to contain it and deal with it if possible, and they will continue to work on it and contain it. If you look at it, it's about $18 billion in debt that China Evergrande has. The Central Bank of China has $3.2 trillion in monetary reserves. So this is 0.5% of what the Chinese central bank has in monetary reserves. And that excludes the several trillion dollars that the China Investment Corp, the sovereign wealth fund, has. So the Chinese government has the capacity to bail this out. It's sort of like the real estate crisis that hit the United States in the late 80s, early 90s, which most people don't remember occurred because it was a gigantic crisis at the time, and the Treasury and the Fed dealt with it. Alan Greenspan, who was running the Fed at the time, created and chaired the Resolution Finance Corp, I think it was called. At the time, people thought this is a massive multi-billion-dollar crisis in US real estate, a lot of underwater investments in real estate. It's going to take decades and trillions of dollars to resolve. They created the Resolution Trust Corporation, and over about 3 or 4 years and $200 billion, they cleaned up the real estate situation for a while. Unfortunately, they didn't change the rules, so those excesses came back to bite us in 2007, 2008, 2009. But they solved a problem that looked like, at the time, immediately, oh my God, multi-trillion dollars in decades to resolve. 4 years, $200 billion, which is very interesting because Sheila Baird, who was running the FDIC in 2008 when we had the next crisis, said for $200 billion, we can stabilize the mortgage market, and then we can value the derivatives based on it, and we know how bad of shape the banks and institutional investors that own those derivatives are. And for $200 billion, we could have resolved it and we could have kept people in their homes. But instead, the Treasury, which was not, it wasn't Alan Greenspan in the Fed, it wasn't Bob Rubin in the Treasury, although in the Resolution Trust time, it wasn't Bob Rubin in the Treasury either, it was other people. We had a Treasury that poured $1 trillion into the top of the pyramid, the banks, as opposed to stabilizing the base, which flies in the face of basic economics and finance. But that was then, that was not now. China Evergrande is not a big deal. And I would be surprised if I see any noticeable, measurable effect on the gold and silver markets from it. So that took longer than I thought it would to get it out of the way. But anybody who tells you that China Evergrande is the shape of things to come, and you better be buying gold and silver because the world's going to blow up, they're fear mongering. And we see that all over the place. I'll end with a chart on that. A little bit before I talk about how we look at our gold price projections, China's CPM Group's research, very simplistically defined, is based on 4 broad pillars. And those broad pillars are the fundamentals of each individual market, microeconomic, ground up, fundamental research, data creation, generation, and analysis. The economic and political environment, that macroeconomic top-down analysis, market conditions, which are basically what's going on in the market, but it's shorter-term events and it's events that don't necessarily show up in supply and demand fundamentals. So what's going on the COMEX, what's going on in London, what's going on in Shanghai, if there's a refinery problem someplace, things like that. Market conditions that can have a shorter-term effect. They won't necessarily show up in your fundamental analysis, but they will show up in the prices. And then we use technical analysis, and we use that for timing and sizing the price projections. So we look at the fundamentals, we look at the economic environment, we look at the playing field, those shorter term market conditions, and we say we think the price of gold or silver or platinum or copper or manganese or tantalum is going to rise or fall. And what's a realistic and reasonable expectation for how fast and how far and when it might rise or fall. So that's how we approach these markets. Now, investment demand drives gold prices. Mine production, secondary recovery, fabrication demand, investors, central bank buying and selling, those are all important. But the single most important factor determining whether gold prices rise or fall is investment demand. So we spend a lot of time looking at the macroeconomic factors that drive that investment demand. If you say, why do investors buy gold? Yes, some investors buy gold as a commodity based on its supply and demand outlook. Some because they've been fed bad data and they say, oh, we're running out of gold, we're running out of silver. but they buy it as a commodity. But with gold, that's the sixth and least important factor when you do econometric studies, like what's driving the gold price. Other factors exogenous to the gold market are much more important. Investors buy gold as a safe haven. They buy it as a portfolio diversifier, as an alternative asset, because it reduces the risk and increases the return of your portfolio over time if you don't have too much gold in your portfolio. It's an inflation hedge. It's not a good inflation hedge, and I'll talk about that when we get into inflation on Friday. But it is an inflation hedge, and even if it were not a good inflation hedge, investors buy it as if it were an inflation hedge and as if inflation was a problem. I should clarify that. Gold is a good inflation hedge when you have significant inflation. When you go back to the 70s or you go back to the late 40s and you see inflation of 5, 7, 14% on a persistent basis, gold does very well to protect from that kind of catastrophic inflation. It doesn't do well against that gnawing 1, 2, 3% per annum inflation that really deteriorates purchasing power and living standards on an ongoing basis. But we'll talk about that on Friday. People buy it as a currency risk hedge, and that's a good one. They also buy it as a form of savings and as a commodity. So those are the 6 broad categories of issues that we look at and say, okay, what are investors thinking now? And this year we have 1979, 1986. I was doing this in 1979. And then we have more current years. And we look at each of those factors and we rate them. And right now, our view is that as an inflation hedge, it's flashing yellow. It's not red. It's not like inflation is not an issue, but it's not green. It's not like inflation is raging. And we've beaten that one up a lot, and we'll talk more about it on Friday. A safe haven. Yeah, it's sort of good as a safe haven because there's a lot of uncertainty, but it's less good than you can see in 2018, 2019, 2020. Then things were a lot worse off, and there was a much greater uncertainty across the spectrum of political, economic, financial, and personal issues. And it was green. Yeah, buy gold as a safe haven. Things have gotten a little bit better this year. We expect them to get a little bit better next year, or stay about the same this year, next year. So it's orange, it's yellow. Currency hedge, green. You look at the volatility in currency markets, you look at all the people who are saying the dollar's down and the dollar's going to collapse. They may be wrong, but there's a great deal of uncertainty and volatility in the currency markets, and that's probably going to continue. Savings, always makes sense to have gold as a form of savings. Alternative asset, yeah, okay, you've got record stock markets in the prices in the United States based on sugar, water, and that sugar high is going to wear off at some point, and it probably makes sense to buy things that are relatively low, like gold and silver, and not lighten up your exposure to things that are relatively high, like stocks and bonds. And then as a commodity, it's kind of neutral. It's flashing yellow. It's a little bit tight. What we've seen in this market is that if investors continue to want 30, 40 million ounces of gold, the price is probably going to continue to rise, and we think they will. So that's how we come up with our price projection on a longer term basis and on a shorter term basis for gold. We look at the factors that are driving investors to either say, I want to buy more gold, or I want to buy less gold, or I'm just very content where I am. One last chart. The dollar is not collapsing. I keep hearing this, and we showed you these charts last week. These charts are from last Friday's presentation. You can see that while the dollar, is down from where it was at the peak of the pandemic, it's still relatively high, and it's relatively high on an ongoing basis. And you can see here on a shorter term basis that I came down after the pandemic, and it hit these lows, and it's gone up. And it's very interesting because we showed these charts last week, and we said the dollar is not collapsing. And of course, the commentary from those people that I now understand I should completely avoid is like, you know, what a fool you are, Mr. Christian. The dollar is collapsing and everybody knows it. Everybody except those people who are buying the dollar and lightening up on their euros and pounds and Swiss franc and yen. That's all I've got for right now. It's a busy day. The markets are doing sort of, well, they're stronger than we thought they would be, at least gold. Silver's around 2250. We still think that they have some risk for some short-term profit taking, but we expect them to strengthen modestly over the next 2.5 months. And we think that as we move forward, economic attitudes on the part of investors will become more positive toward the economy, and that view of holding gold as a safe haven and an alternative asset might dissipate a little bit more. We'll talk Friday and we'll continue the conversation. Thanks for your attention. Have a good week.